Imagine it's June 12, 2026. You wake up, you open your brokerage app. SpaceX, the company that literally launched rockets to Mars, just went public. The stock is up 67% in 3 days. Elon Musk is officially the world's first trillionaire. Everyone on X, Reddit, every finance podcast, they are calling it the trade of the decade. So you buy in and then in 4 trading sessions, you watch $620 billion in market value disappear. That is not a hypothetical. That happened last week, and the scary part for most retail investors, the worst is probably still ahead. And today I want to explain exactly what happened with SpaceX stock, why this crash was entirely predictable, and what this movement actually means for your portfolio. Let's start from the beginning. Because the SpaceX IPO wasn't just big, it was structurally unlike anything we have ever seen. On June 12, SpaceX priced at $135 per share. It raised $75 billion, the largest IPO in American history, and within 3 days the stock hit $225. At its peak, SpaceX briefly surpassed Amazon and Microsoft to become the fourth most valuable company on earth at a $2.66 trillion valuation. Then the sell-off began. Wednesday down 5%, Thursday down 3.6%, Monday down 16.4%. The single worst trading day in the company's short public life. And by Tuesday, shares had briefly fallen below $150, wiping out over $600 billion in market cap. Peak to trough, SpaceX crashed 31% in 4 sessions. People who bought at the top didn't just lose paper gains, they lost real money. And the media framed this as a tech sector sell-off. Micron was down, AMD was down, Nvidia was down. But that's not the real story here. To understand what's actually happening with SpaceX, you have to understand how this IPO was engineered. So here's the detail. Almost nobody in the mainstream press is talking about clearly. SpaceX sold only 4.2% of its total shares in the IPO. Think about that. Out of 13 billion shares outstanding, only about 555 million were made available to the public. That is an artificially tiny float. Most companies going public sell 10 to 25%. SpaceX sold 4. When supply is that scarce and demand is sky high, prices do only one thing. They go vertical. And that's exactly what happened. The IPO pop wasn't organic price discovery. It was a scarcity illusion. And here's where it gets worse. Why, as the stock was crashing, SpaceX announced a $20 billion bond sale. By Tuesday, that number had grown to $25 billion, one of the largest debt issuance in the AI era. The company received $90 billion in orders for those bonds. The market read this correctly. SpaceX need cash, a lot of it, and is willing to take on significant debt to get it. Because the financials were already difficult to justify. SpaceX trades at roughly 104 times price to sales. Its profit margin is negative 45%. The company lost $9.36 billion over the trailing 12 months or $19.3 billion in revenue. Morningstar has a fair value target of $63 per share, roughly below 60%, where the stock is trading right now. Michael Burry, the man who caused the 2008 collapse, has said the company is likely worth less than $1 trillion. Paul Krugman called it a $2.75 trillion meme stock. Now I want to be balanced here because SpaceX does have a real bull case. Starlink, its satellite internet business, grew at adjusted EBITDA 86% in a single year. It has over 9,600 satellites in orbit and a near monopoly on low latency orbital broadband. The company has locked in a $920 million per month deal with Google and is building out an orbital data center network that, if it works, changes the revenue equation completely. But here's the honest truth. At current prices, you're not buying the business, you are buying the story, and the market is starting to realize that. This is not the first time we have been here. Look at every major IPO in the last 2 decades. Facebook went public in 2012 at $38 a share. Within 3 months, it had lost half its value. Saudi Aramco, the largest IPO at the time, experienced a sharp drawdown within 6 months. Uber, Lyft, Rivian all followed the same arc. IPO pop, euphoria, then a painful correction as really set in. A Reuters analysis of the 50 most valued IPOs in the last 5 years found that investors would have been better off buying an S&P 500 index fund about 3 quarters of the time instead of the IPO. And the data on mega IPOs is sobering. The 15 largest US IPOs since 2006 average a 50% drawdown during their first year of trading. The average first year finish was 33% below the IPO price. If SpaceX follows that historical average, the stock could see around $67 at some point in the next 12 months. That's not a prediction, that's just what the pattern look like. And here's the part of this story that should make every retail investor sit up straight. And right now, only 4.2% of SpaceX shares trade freely. The rest are locked up. And between now and early 2027, that float is about to expand dramatically. The first wave hits in August, shortly after SpaceX reports its first quarterly earning as a public company. Institutional backers and early VCs can sell up to 20% of their holdings. If the stock closes above $175 for 5 of its first 10 trading days, they get an additional 10% unlock. The stock has not hit $175 since the crash. After that, employee share unlocks kicks in on a rolling schedule. 7% increment at 70, 90, 105, 120 and 135 days post IPO. One analyst from 22V Research estimates that insiders could potentially sell 44% outstanding shares by early September. That would increase the current float by roughly 900%. The market right now is pricing this company based on extreme scarcity. What happens when that scarcity disappears? When 13 times more shares suddenly become available? Supply goes up, price goes down. That's basic economics. The one protection retail investors have, Elon Musk himself, cannot sell a single share until June 2027. His 6.4 billion shares are frozen, but everyone else, they are watching the clock. August is the highest risk month on the calendar for anyone holding SpaceX right now. So what do you actually do with all of this? First, if you bought SpaceX near the top and you are in the red, don't panic, sell based on emotions, but also don't hold based on hope. Look at the fundamentals, look at the lockup schedule. Make a decision based on what you know, not what you feel. Second, if you haven't bought in yet, understand what you are actually buying. This is not a value play, this is not a cash flow story. This is a bet on Elon Musk's vision of the future, materializing faster than the debt grows. That may work, but you should know that's the bet you are making. And the third, watch August. The earning report and the first major insider unlock will be the single most important event for this stock in 2026. The reaction to those numbers will tell you a lot about where this goes next. And finally, Remember that SpaceX isn't just a stock. Its performance directly impacts the IPO appetite for Anthropic and OpenAI, both of which are watching SpaceX every single day. If SpaceX can't hold its IPO price, the entire AI IPO pipeline gets repriced lower. That is the macro read that most people are missing. The SpaceX story isn't over. It might be one of the most important companies of the next 50 years. But the most important companies don't always make the best stocks, especially right after the most hyped IPO in history. And if you found this useful, subscribe. I cover macro and markets every week. No hype, just the honest picture. And I'll see you in the next one.